Hi, and welcome to our keynote panel on Finding Opportunity, Multi-Asset North America Investor Outlook. I am Igor Tsukerman. I'm a President and Chief Investment Officer of Passpon Advisors. I will be moderating this panel. I Just a few words about me and my company. Passpon Advisors is a boutique financial advisor company. We specialize in thematic and impact investing. We've been in business since 2012. Prior to that, I worked on Wall Street for nearly 20 years in places like JP Morgan and Merrill Lynch, as well as in some startup technology companies. I'm joined today by two panelists, two experts in the field, Dr. Linda Zhang. She is the CEO and founder of Purview Investments, which is also a New York-based firm, independent investment firm, and a registered investment advisor. Her firm offers actively managed ETF solutions focusing on global investing and impact investing to individuals and endowments directly and indirectly through other various family offices and endowments. Linda developed extensive expertise in building ETF managed solutions, ESG investing, macro investing, quantitative research, and portfolio management. She's previously she led the investment team at Windhaven Investments, and before that spent many years as a portfolio manager of global multi-asset funds at institutional asset management companies, including BlackRock, MFS, and State Street Research. The other panelist joining us today is Stuart Paskin. He is an investment director and multi-asset investment specialist with Aberdeen Standard Investments. He conducts research on multi-asset strategies and themes to lead to dialogue on specific approaches and investment topics with the firm's clients, prospects, and consultants. He collaborates with the multi-asset investment team in multiple ways, including working with the team on the development and maintenance of an innovative and diverse suite of investment products and solutions. Stuart's articles have appeared in industry publications such as the Journal of Portfolio Management, and he is a frequent speaker at industry conferences. He's had more than 25 years of investment experience. He began his career at State Street Global Advisors in a portfolio management capacity, and spent a number of years before he joined Aberdeen Standard Investments in 2012. So before we jump in, we have a very interesting panel for discussion for you today. We'll be talking about the outlook for multi-asset investing. We will also be looking at volatility, at macro risks and opportunities, and also we'll touch on the ETFs and their impact on the markets. So before we get to it, just a couple of items. We will leave some time for the Q&A. So if you're listening to us, if you have a question, feel free to type it in. We will probably not interrupt until the very end, but we will see your questions, and if we have time, we'll try to answer them. Also, I'd like to run a quick poll just to see what the audience today came to learn about. It will help us, the panelists, to steer the conversation towards what you would like to hear. So this is just a quick poll to see what you're trying to get out of today's discussions. You should see them on your screen. The first, there are 5 questions. The first one is, it's one question with 5 choices. The first one is you're looking to get the market outlook from experts, or you're trying to get new investment ideas. You're looking to adjust your asset allocation, reassess your portfolio risks and protection needs, or learn more about specific asset classes and ways to invest in them. So we'll just have another 20 seconds or so. Please let us know. It will help us drive the discussion today. Please use your screen to vote. We have about 10 seconds left. All right. So the answers we're getting are people are looking to get the market outlook from experts and new investment ideas. Sounds good. So let's jump straight to it. Multi-asset market outlook. Obviously, it's been an interesting start of the year. What can we expect going forward in the markets? Stuart, would you like to jump into that?
Okay, great, Igor. I'd be happy to. So I'm just going to advance the slides here and take a look at the first one that I've put out there for people to view, so you get a sense of where sort of the conclusion, if you will, of all the work that goes in forming our multi-asset strategy, while we're taking into account 4 key factors, that is the valuation of markets, monetary policy, the behavior or the more technical drivers of markets. At the moment, the fourth one would be corporate profits, and that's where that's really most readily observable in terms of how our outlook is formed right now, because we do have a overweight to equity markets. As we get more granular, we have specific views on which of those developed or emerging equity markets that we most prefer, and in fact don't like one particular equity market, which is one major market, which is the UK. So, what I wanted to do is just kind of walk through the economic environment, as well as some of the behavioral aspects that we see right now that's led us to that constructive view on equities, as well as view that interest rates aren't problematic. What's priced in is what should well unfold from an interest rate perspective. So while we see a bit of a weakness in global economic trade and global economic numbers, really our models are not adjusting or changing all that much. That it's very much what we would associate with the really strong 2017, and pullback from here is very marginal and just reflects what had the potential becoming overheated conditions, and in some sense is a good thing for the healthy economy that you see things backing off slightly. So all our models, whether it be recession probability models or nowcast models, where we do everything we can to take in the most recent information and forecast out what's ahead for the next 6 to 12 months, is a constructive from a global economic standpoint, and therefore corporate profits should continue to realize the benefits, whether that's in the U.S. or other parts of the world. We still see a good, healthy mix of things happening in the developed world vis-a-vis emerging markets. And we'll talk about risk later and what we see for the potential that there may be a further pullback in China. Emerging markets have had a nice recovery, continue to deliver, but overall still see a tilt for the better growth on a relative basis on developed versus emerging. And what I would argue is that the factors, of February when markets were very unruly and inflation concerns came about, we think that is reflective of greater risk going forward. We'll talk about how we think that influences the volatility environment going forward, but that is very much something that's now behind us, and the overall Goldilocks type conditions that we've seen for some time now continue to be our base case. We've got, looking 2 to 3 years out, we continue to become more measured because we think fiscal policy in the U.S. Hasn't had the stimulative effects yet, but as it does, the potential for overheating grows. So we very much believe that the tax cuts are coming at the wrong time in terms of where we are in the cycle. So there's really greater risk. While in the short term it's positive and it's healthy for corporations as they buy back more shares, and that makes everyone comfortable with debt levels and what maybe not so much too fast of a economic changes, but enough new capital investment that economy continues to move along, but we see eventually that that's going to be overstimulative, and it does sort of raise our concerns about when that recession should come about. So we as we take more granular approaches in portfolios, we'll certainly see that come through, as well as we would expect to see this constructive view of equities start to really ratchet downwards. So with that, I'd like to take it back to you, Igor.
Great, thanks for that overview, Stuart. Linda, is there anything you'd like to add to that?
Sure. Hi, good morning, everyone. This is Linda Shang, Purview Investments. Stuart, thank you for a very comprehensive roadmap about all of the major asset classes that you've described. And I like you, Purview is actually a dedicated global multi-asset manager. I guess what differentiated our approach is we completely rely on ETFs to express our global macro views, and we also make investments through ESG lenses. So I would agree with you on many assessments of what's going on and what's likely to happen in many asset classes. I think this year is a very challenging year for investors because it seems like there's no place to hide. When equity market has a lot of volatility, typically fixed income is a good place to hide. But this year we happen to be entering or continue to be in a cycle of interest rate rising. So if you're buying the fixed income index based ETF or mutual funds, right? Chances are you're losing. The broad Bloomberg Barclays index-based ETFs, for example, has lost over 3%, right? And if you look at equity world, U.S. large cap is pretty flattish until last couple of days recovery. This is not a paradise for global investors, certainly. But it doesn't mean it's not a good environment to invest. Actually, to the contrary, I think this is exactly the environment where you really have to look deeper around the world and to look for opportunities. I want to focus on one piece. I could complement what Stuart was saying. Maybe add on to what he was saying. The U.S. interest, I think the investors have put a lot of focus on the rising interest rates, and I think that's for a good reason. So let me put it to Igor. If you could put the slide 7 on.
Sure.
Yeah, so slide 7. I'm going to show you that that's slide, no, that's not slide 7. If you keep going.
Yes.
Yeah, let me do it. Yeah.
Here.
Let me do it. Okay.
Yeah, here we go.
So I don't know how that looks on your screen. My screen doesn't look too big, but the point is this: U.S. interest. This is the yield curve, global yield curve. I would call that 4 major economies yield curve: U.S., China, Germany, and Japan. So what you see on top, those are 4 pairs of yield curve across all the spectrum up to 10 years. And you can see the U.S. yield curve, yes, which is green, it has shifted up, right? And so has German yield curve, the blue one, and even Japan, right? The red one, they have also shifted up. So the bar on the bottom that shows you the degree to which each maturity fixed income has gone up. But there is one exception. China is the second largest economy, right? Chinese bond market is also, Chinese equities market is second largest, and bond market third largest in the world. But this is because of the capital flow issues. Most people haven't really paid attention to the central bank, PBOC, right? The same way that people pay attention to the Fed, ECB, and Bank of Japan. And in my opinion, this is a great opportunity to study, to understand what's going on in China. If you look at what the China's monetary policy is actually the opposite, while the 3 developed major central banks are either tightening or on the way to unwind their quantitative easing program. PBOC actually recently eased again by lowering its reserve rate. So China is actually in a very different environment. The interest rate is higher, right, and it's dropping, and currency is very stable. So this is the type of fixed income we like. So half of you said you like to learn about new investment ideas, and this is one idea you could study, right? For example, China fixed income. There are ETFs that would give you that exposure. So I'm talking about Chinese bond, in particular onshore bond. And this is another development that you may want to study, that Chinese bond, most of you are aware, China Connect program for A shares, right, for local shares, the China Stock Connect program is well understood, but the Bond Connect program just opened last year, right? So which means overseas investors, institutional investors can have access to onshore assets without having to apply for quotas the way they used to do. So this is a fascinating asset class, and we should all be watching for, in my opinion. And this year, it's fascinating to look at China bond index, right? Not only it's positive, it's actually doing better than majority of equity index. It's actually up 5% on the backdrop of declining interest rates and strengthening in currency. Yeah, so that's what I like to add on the global assets review and specific ideas part.
That's great, Linda. Thanks for your comments. I don't know about you who are listening in, but I have a lot of information. I have a lot of questions. If you have questions, please make sure you type them in, so we'll try to address them at the end of the presentation during our Q&A session. But for now, we'll move on to the next subject of discussion, and I am sure a lot of you are interested in this aspect of it. It's the volatility. If you were investing last year, and I hope you were, the this was rather an unprecedented time when a lot of equity markets, not just in US but globally, have been doing really well with really low levels of volatility. So many investors may have forgotten what volatility looks like, and of course, came February of this year, and everybody was reminded. And volatility hasn't really left the market, and doesn't look like it will for the foreseeable future. So, what causes the volatility? What drives it, and how would an investor protect themselves against different types of volatility in this market? Linda, would you like to take the first crack at it?
Yeah. Okay. Sure. Yeah. There are plenty source of volatility, right? So let me just pick a couple of. The first one is clearly, the credit cycle, right? The interest rate, which is expressed by the interest rate development, that the Fed could raise rates too quickly and too many times, right? That's clearly not very good historically to equity markets as well as fixed income markets. And another source of volatility, which some people may think it comes and goes, but I think this is a new prolonged source of volatility for a company, for company's profit, for capital markets, not just stock markets, but fixed income markets, which is the relationship between trade relationship between China and the U.S. Right? I think many people might have understood the implications of that. They think it'll just affect farmers. It'll just affect Boeing. But people tend to forget there's a multiplier effect that the two largest economies and who happens to be, the largest participants in global trade, and if there's continued friction, then that not only affects companies directly, but also affects their suppliers. And today, almost every single industry can be classified up to some degree. There's a global supply chain issue. So these two countries' trade relations are really going to affect every single country in the world. It's going to affect Japan. It's going to affect Germany. It's going to affect many countries and sectors and companies through multiplier effects. And so it's just not critical to companies' earnings and to stock markets. China also happens to be the largest creditor to the U.S., right? So in China, to slow down the purchasing of treasury, that's going to have even more pressure on the rising rate environment. And I think that's something that's I don't think it's going to go away. It's not a matter of just this talk. We have seen trade friction happen whenever the economy, the world has new leaders, new economic leaders, and we have seen that certainly back in the early century, early last century, when the U.S. became a multipolar world, along with the Europeans, and the trade friction it lasted for a long time. So the third point is actually again the central bank policy coordination. I think there's a risk that both Fed chairs and the chairman of PBOC, they're new to the job this year, right? When there's a heightened global crisis, would the two be able to coordinate the way that the previous central bankers who know each other pretty well? So that's potentially underestimated risk. Let me stop here.
Okay, some interesting points there. Stuart, would you like to add anything to this? Stuart, any thoughts?
I mean, so for the macro scenarios, that Linda identified, we, wholeheartedly agree that those have the potential. So we have several of them that we're looking at, and again, Linda highlighted several of them. But I think what's really important is looking at the events of February, and in the sense that, yet one more occasion where it was more of a technically driven, while it starts with a macro concern, it becomes much more technically driven. In this instance, maybe it was the most pronounced we've seen in the last couple of years, obviously with the volatility markets showing all the upset, and then ETF, a short vol ETF, having to, not being able to honor its investors who wanted to redeem. So to us, it all comes back to the stage of the cycle, and so that is going to, raise the probability for more volatility in the future. But just the overall base level of volatility, we think, has risen through the course of the beginning of this year, as more investors will be factoring in that scenario of higher rates and the spillover through, feed through from inflation and the spillover into equity markets. So you definitely have that base level of volatility rising, and where the volatility will come from. Again, there's a handful that we can talk more about what those are, but we think just the technical nature of markets now with algorithmic trading and the things that happen that have happened since the financial crisis that have created a overall less liquid environment and have raised this potential for negative feedback loops. And in fact, we've seen them. And while markets do reach this state of calm relatively quickly, maybe not this last time, not quite as quickly as the prior events of 2015 and 2016, what you do see is as the cycle matures, that type of scenario grows that much more likely and can be that much more affecting markets even more severely than it has up to this point.
Okay, thank you for that. So one part of the question that I guess we didn't really address is what should an investor do in terms of volatility? Just write it out. Would you recommend any specific strategies? Those volatility ETFs you mentioned, maybe options, maybe changing the asset allocation mix, raising cash. Any thoughts on that, either one of you?
Yeah, with further strategies, we do not play volatility ETF. You mentioned that. Yeah, some of these option-based ETFs and the leverage ETFs. The people talk about, would you use inverse ETFs, for example, or leverage inverse ETFs? For us, we don't use that because the only time you should use that is that you are watching it every single day, and you got to roll these. You got to keep trading those, right? So those. Right,
they're well documented risks for those because of their compounding. I understand, right?
Exactly. I actually just have a paper accepted by Journal of Investing. I actually surveyed the global leverage ETF and inverse ETFs, checking their volatility in the short term. So the short-term volatility could much bigger than what their leverage multiplier suggested. So that's no. Sorry, not for us. Maybe it's good for other people, right? If you trade it and you know what you're doing and you're trading it all the time. And for other strategies, clearly, if you are able to trade option strategies, you can create that. You can create option strategies. But for people who are not equipped to do that, certain type of fixed income, certain strategies, it could work. Some type of barbell strategy, having a little bit long-term treasuries, longer-term treasuries. It could hedge during market when market collapse, right? But as far as how much you use, you have to be careful, just because we are in the rapidly rising rate environment, right? So some people like to use gold, use part of the gold as part of their portfolio, and that's certainly one option. But remember, gold is also volatile. And lastly, cash can be a king, and we learned the lesson in 2008. But having some cash cushion is always good. So in the end, which one you use and how much you use, that's really a science and art of portfolio management.
Right.
And depending on your investment, the overall portfolio risk return profile.
Stuart, anything you'd like to add to this? Yep.
Sure. So I'm going to move the slides to where I can kind of speak to a portfolio that is taking on that challenge. What you do, has the ability to go into cash. We've not chosen to have high cash allocations in this portfolio. And just, if you're looking at, hopefully see the slide now about, what we're doing to rotate a longer term diversified growth type portfolio amongst asset classes, taking into account, these factors that, people are familiar with, the spread available on corporate and high yield bonds, what the outlook is for different regions of the world. But you see, the first thing that comes along is the move out of the lower grade, I should say higher grade corporate fixed income. So the yield opportunity there, the recognition of just lower real rates and lower settings for rates globally, had to be accounted for in this type of portfolio. So it meant a shift into high yield and emerging market local currency, as well as going into more, say, exotic type asset classes where we can get the exposure in infrastructure debt or insurance linked type opportunities. So, the overall portfolio mix, continues to change in a fairly pronounced way. You see at the end of this where we are now with substantially higher emerging market local currency allocation. We've pulled back from high yield debt and continue to back away from equities. So to us, one way to take on that challenge are these relatively modest moves, incorporating a time horizon of 2 to 3 years and even out to 5 years in sort of the formation of this portfolio. So maybe not as exciting or as tactical as some investors want to be with different, some pots of money, but for that pot of money that they're really have a fairly high level of, there's some element of safety, and sort of riding out the cycles. We do think it's really important to be able to ride out where we are in the current cycle, to pull away from certain asset classes that just don't offer as much opportunity, and structure the portfolio around diversifying asset classes, which admittedly up until now, haven't been a big contributor return, and people have been fortunate to keep their portfolios in very standard mixes and allocations. But Linda already highlighted the government bond, and also you could throw in investment grade bond world. The returns, people are starting to see how low those returns are actually going to be. We're not going to get the benefits we've gotten over 30 years of just lower and lower interest rates and flat yield curve. Just no chance for carry in longer term or medium term bond portfolios. Okay,
thank you for that. So We'll move on to the next question, which is very connected to the volatility, and this is macro risks and opportunities, of course. There seem to be so many of them. If you read financial press or if you watch CNBC, you probably hear about macro risks all the time. Before we let the panelists tackle that question, we'd like to see what the audience thinks. So here's another quick poll. This one is to gauge what you feel is the biggest macro risk to the markets right now, and this is just a short list. Doesn't include perhaps all the inflation risks. In fact, all the macro risks. In fact, inflation was one of them that Stuart also mentioned, was a big one back in February, and it's not on this list, and there are several others that we can talk about. But please vote what you believe is your biggest risk to your portfolio, to the markets, whether it's U.S. and global economic trends, rising rates, tariffs and trade wars, geopolitical tensions, or U.S. and European regulations. I guess that last one is also rather understated, at least in my opinion. But I'm curious to see what you, the audience, think about all this. Please vote. We have about 15 seconds left on that, and then we'll let Linda and Stuart answer that question. And again, a reminder, if you do have questions for the panel, please feel free to type them into the Q&A window, and we'll take them at the end of the session. Did I mention that the votes are anonymous? Don't be afraid. Please let us know. It will help us drive the conversation. All right, so I'm going to close the poll. We didn't get too many votes, but it seems like geopolitical tensions stand out. Stuart, would you like to take that one first? Would you agree with geopolitical tensions, or is there a bigger focus in terms of macro risks as far as you're concerned?
Yeah, I mean, from a perspective of building multi-asset portfolios, for some time, the rising rate is the key risk, the one that we're particularly focused on, because the natural tendency for when you're building a diversified multi-asset portfolio, say where you can take some leverage, you can get that sort of risk parity like structure, or at the margin at least, something similar, where you're getting your interest rate exposure, so you're protecting your portfolio with a healthy amount of government bonds, and just where we are in the cycle now, where we think that diversifying benefit is not as great from government bonds, and just have the view that rates, the likelihood of direction of rates is more to the upside than the downside, and sort of in the U.S. sort of leading the charge there, but Europe not behind certainly, but those rates we'll see those rising. That just to us stands out as from a multi-asset portfolio construction as the scenario, the biggest macro risk that we're taking on.
Okay, sounds good. Linda, where is your focus in terms of macro risks?
Yeah, Igor, I actually agree with you on the regulatory risks around the world. And most of us perhaps have followed the European General Data Protection Regulation, GDPR, that's going to be, if it's on track, should be implemented later this month. And this is the first time that you have a very strict data privacy law that's aimed to protect the individual privacy rights in the European region. And we probably wouldn't be surprised that the U.S. and other regions may at some point have a similar version of such regulation. And this could be huge to the technology giants, companies, and then to their business model and to their earnings, their revenue model, right? Most of them are based on, they provide free services in exchange for your information to better market, other products. So if this rule is influencing many places, including here, then it's going to be a direct challenge to the business model. Right now, IT represents a quarter of S&P 500 index, but it contributed to over 30% of the profit as of 2017. So this could be, and many of these S&P 500 companies, they have huge exposure in Europe, right? Especially the tech companies. So how is that going to translate into the revised profitability of these companies? I think it's really worth watching. But I also like to highlight regulatory opportunities. To me, there has been a global, I've been following global regulatory push for green technologies, like green transportation, green utilities. It probably doesn't feel that way as we're sitting in this country, but we have countries, some Nordic countries such as Norway and Netherlands. They have already passed regulations to ban the sales of fossil fuel cars by 2025. And we're just talking about, this is just 7 years away from now. And other countries, UK, France, and Germany, they are proposing to come up with a ban on the sales of such traditional cars, fossil fuel cars, by 2040. In January, California just made a proposal. Its own timetable is 2040. So we don't know if it's going to pass or not. And China, which is right now has the largest electric vehicles, and it's working at its own table. So the technology breakthrough and the regulatory push for green transportation, and I think that presents tremendous investment opportunities for the new type of auto companies and companies who are quicker to transition into new technology. And so to me, that I think that in this case, macro or regulation risk actually can be turned into investment opportunities that investors should pay attention to. And it also has actually an impact on commodities, the demand for commodities. So, we know the geopolitical tension with Iran last few days have really pushed the energy price up. So in the long run, there are many research that have suggested global demand for traditional fuel for oil could at some point peak, and within next generation, within our lifetime, it could peak. So that could very much challenge the way that investors have invested in energy, right? Many of us, especially those of us who think about it from multi-asset perspective, we want to hold energy for diversification, for price enhancement, right? And for geopolitical hedge. So if in the long run, the role of traditional energy has changed, and we may have to reconsider the traditional roles that they play in a multi-asset portfolio in the long run.
Okay, thank you for that. So now we're ready for the last prepared question for this panel, and that deals with the rise of ETFs and how they impact the markets. So I'm sure if you've been investing for a while, or even if you're a new investor, you're probably familiar with ETFs. Some 10, 15 years ago, when ETF industry was in its infancy, the impact on the markets was negligible. Nowadays, many people invest in ETFs. A lot of investors, a lot of advisors for the investors prefer ETFs, and in many cases only use ETFs. So obviously it's a major force in markets today, and we have gone from just the basic index ETFs to I guess ETF 2.0. We have now strategies embedded into ETFs, smart beta, multi-factor, and of course, we now have thematic and impact ETFs. Linda, you just mentioned opportunities in green investing, and that would definitely fit within impact ETFs and thematic ETFs, something that your firm as well as my firm is focusing on. Would you like to talk about the ETFs in general and perhaps thematic and impact ETFs specifically?
Sure. Yeah. You know, that's a nice summary of the development of ETF industry. You know, I personally grew up professionally in the traditional mutual fund world, right? You know, I managed multi-asset mutual fund fashion at BlackRock and FS. But what, you know, just by sheer a chance that I joined Windhaven about 5 years ago, and that's when I started fully immersed in the ETF ecosystem. And I was very lucky that that's when the ETF really started taking off. and you can see in the last few years, most mutual funds as a whole has experienced, net outflows, even though the AUM may be growing because market is expanding. But if you look at net flows, we have had consecutive net outflows of mutual funds, yet ETF has grown rapidly. So ETF today, you know, we have over 2,000 ETFs listed just in the U.S., right? And we've seen similar growth in other regions. They might be slightly behind the U.S., but we see fast growth in other places. And so when I look at the growth of ETFs, you know, it kind of reminded me of how I managed global multi-assets, you know, starting from 2003. It's really it's evolution of structures for multi-asset asset managers. So back in 2003, you know, I was essentially managing fund of portfolios, using our own company's portfolios to structure multi-assets, right? And later on, at a different firm, at MFS, you know, we were using our own firm's funds. So we're managing mutual fund of funds, and we're able to overlay global macro long-short overlay. And so at BlackRock time previously, I create a global macro overlay that use derivatives and currency forward contracts to gauge up and down, to scale up and down either equity risk or currency risk, right? And due to necessity, when mutual funds were not allowed to use equity index futures, and for certain countries, then I came across the iShares EW series, right? EWZ, you know, the Brazilian ETFs, the South Korean ETFs. So that's when I started using in 2005. But the choices were limited back then, and now we have so many choices. And I think that we have really graduated from the very basic to thematic ETFs. These days you can find very specific. So people were saying you're looking for specific ideas, right? I think the future of multi-asset management is no longer just putting together basic vanilla blocks. If you want to go to US, S&P is not good enough. You have to go to thematics. You have to go deeper into sectors, go to themes. Similarly, if you invest in emerging markets, right, the VWO world, right, that just one ETF covers all emerging markets, that's not the way to go. You have to go into much deeper, go into thematics, go to countries, go to sectors that have growth. And these days, you can find ETFs that express both themes, sectors, and countries and factors, right? But and now what's really interesting is in terms of content, what's in ETFs? ETFs is simply just a structure, right? It started with holding passive content, index-based content. Now there are more and more active content-based ETFs where managers put in active ideas right into it, but increasingly it is another segment of ETFs that we have seen faster growth. It's still small in base, but it's faster in percentage rate, which is ESG ETFs. So if you look at slide 8, I can forward that.
I got you.
Oh, you got me?
8.
Okay.
Yeah.
So if you forward to the slide, 8. Yeah. So this is give you a snapshot of who are the major players in ESG ETFs. So BlackRock essentially, iShares, they cover about 2/3 of this space. We currently have over 40 or 50 self-labeled ESG ETFs, and by AUM, BlackRock holds about 2/3 of it. And SSGA, State Street Spider, they hold close to 20%. And it's very interesting that BlackRock has the one with the longest history, and also it has a product that just hit 1 billion earlier this year, right? Most of their ESG products are benchmarked against MSCI ESG research indices. They tend to be ESG ETF cover all, the covers environment and social and governance. And what's interesting is with State Street is State Street has star ETFs, right? They came out with SHE, which is investing in over 130 companies that have more progressive policies on, having women on the board, right? And the latest newcomer is Nuveen, right? Nuveen NewShare. Last year they came out with a suite of ESG products that essentially it gives you full toolbox for asset allocators to use. But what I think what we may see more and more is what I call impact investing. That goes beyond just you're good, you're okay with E and S and G. And I think ETFs such as green bond ETF, right? They invest in that instrument issued by companies to finance green projects, and this is a fast growing asset class globally, right? And SHE ETF, I consider that's impact ETF, and I think we're just going to see more and more coming. So let me stop here.
Yes, thank you for that. It's actually very, very interesting the way that this market has been developing, because part of the solution suite that my company provides, for example, is a portfolio of ETFs based on somebody's risk assessment, and we give an option for to make it all impact investing ETF solution, and that's fairly new because a year ago you wouldn't be able to do um, all the asset classes in it, and now you can. And as you, Linda, mentioned, this is only the beginning. I'm sure it's going to grow much more. So we only have a few more minutes. Stuart, any quick remarks on ETFs from you?
Well, I mean, we are newer to the sphere. You might have seen the announcement. We just acquired an ETF operation, and it's just for everything you guys described. So having that structure, we think, is essential to be, a complete player in asset management. So I highly support all those comments, and just acknowledge the fact that this is just the beginning for us as a firm in ETFs.
Congratulations.
Thank you.
Well, welcome to the club.
Mm-hmm.
All right. So we are almost out of time. As of right now, we don't have any questions from the audience. So this is a good opportunity for you to jump in. As I said, we only have a few minutes left. You do have the slides at the end of the deck. You will find information on the presenters on the panel. So if you think of something later, I'm sure you can contact them, and they'll be happy to answer your questions, myself included. But in the next minute or so, if you do think of something, please let us know, and we'll try to address it. Linda and Stuart, any parting words of wisdom?
Not sure if there's any wisdom. Yeah, I like to hear questions from the audience, or maybe a question from you, Igor.
Well, one question for you, Linda. You mentioned earlier some interesting choices, some interesting opportunities in China, especially in offshore and fixed income, as well as in potentially some thematic, maybe equities. Any specific ETFs that maybe you want to mention for investors to look into, understanding that this is not necessarily a recommendation, but just something.
I've been very careful not talk about tickers. I'm not sure if I might violate any compliance rule, but
I see.
But I can say, China bond index. If you search for that, you're going to find it.
Okay.
That's an interesting area. Onshore, give you onshore access to China bond index. So this is not meant for endorsement. We're just talking about ideas, right? I'm not saying whether now is a good time to invest. So I just want to clear up. Yeah,
we're all aware of the compliance.
Yeah, there are a couple of companies who have those. Yeah, and I think two companies you can start with. VanEck has a product, and CleanShare also has a product. So you can start studying about this asset class rather than just jump right into the product, I would say.
Right. And one quick question for Stuart then, as we're running out of time. This was a rather comprehensive multi-asset research that you presented to us. I'm sure it's a result of multiple analysts within your firm. I'm just curious, how often do you update it, and what are the primary drivers? Is it just based on calendar, or do you look at some specific events that will make you update your outlook?
Yeah, I mean, when we're taking the 1 year to 2 year type views, what the way that's all what is essential in sort of keeping that fresh is a weekly discussion around the views. So what we like to do is, make for sort of more timely and diving into something specific. Obviously, it's so unwieldy on the one hand, but So rather focus the discussions on particular asset classes, particular dynamics, and how that might affect the rankings of, a handful of asset classes. Because it would be an all-day meeting every week if we were trying to go through, all the asset classes on a regular basis.
Sure, I understand. Okay, well, I think we're out of time, and I don't see any questions from the audience. So, Linda and Stuart, thank you very much for sharing your ideas with us. And to everybody else listening to us, thank you for joining us today. And happy investing. Thank you.
Thanks. Bye.
Bye now.
Bye.